Have you ever wondered why some businesses thrive while others struggle to stay afloat? The secret often lies in their budgeting practices. A budget is not just a set of numbers. It's a comprehensive financial plan that outlines expected revenues and costs. Budgeting is a powerful tool for financial control and strategic planning. It helps businesses allocate resources wisely, track progress, and make informed decisions. By regularly monitoring performance and using advanced tools, businesses can stay on track and achieve their financial goals. Welcome to our exploration of budgeting and financial control, where we'll uncover how a well-structured budget can transform the future of any organization. Without further ado, let's get started. What is a budget and what is budgeting? Budgeting is the meticulous process that culminates in the creation of a budget. It's a forecast of a company's economic activities, typically tied to a specific time period like a fiscal year. The budget includes revenues, costs, investments, and cash flow, aligning with the company's strategic goals and key performance indicators, KPIs. Budget comprises three main parts. Number 1, performance budget. Number 2, liquidity budget. Number 3, budgeted balance sheet. Performance budget. This is the most common form of budget. The performance budget is a fundamental tool in financial management, focusing on the company's revenues and costs. It is designed to control financial outcomes by providing a detailed plan of income and expenditures. This type of budget helps businesses forecast their financial performance, ensuring they allocate resources efficiently to meet their goals. By projecting revenues and expenses, the performance budget enables companies to anticipate financial needs and avoid shortfalls. Overall, the performance budget serves as a crucial mechanism for financial control and planning. It not only aids in calculating financial outcomes but also fosters a proactive approach to managing finances. By providing a clear picture of expected revenues and costs, the performance budget supports strategic decision-making and helps businesses achieve their financial objectives. Liquidity budget. The liquidity budget, often referred to as the cash budget, is a critical component of financial planning that focuses on a company's liquidity, its ability to meet short-term obligations. This budget ensures that a company has sufficient cash flow to cover its expenses, such as payroll, rent, and other operating costs. By projecting cash inflows and outflows over a specific period, the liquidity budget helps businesses maintain adequate cash reserves and avoid liquidity crises that could disrupt operations. In essence, the liquidity budget serves as a vital tool for managing cash flow and maintaining financial stability. It provides businesses with the foresight needed to navigate potential cash shortages and capitalize on surplus periods. By regularly updating and reviewing the liquidity budget, companies can stay agile in their financial management, ensuring they are always prepared to meet their financial obligations and support ongoing business activities. Budgeted balance sheet. The budgeted balance sheet is a forward-looking financial statement that outlines the anticipated changes in a company's assets, equity, and liabilities over a specific budget period. This essential component of financial planning provides a comprehensive view of how the company's financial position is expected to evolve. By projecting future financial standing, businesses can better prepare for upcoming financial needs and strategically allocate resources to achieve their goals. Creating a budgeted balance sheet involves estimating the future values of various balance sheet items based on planned business activities, expected revenues, and projected expenses. For instance, if a company plans to invest in new equipment, the budgeted balance sheet will reflect an increase in assets and potentially an increase in liabilities if the purchase is financed through debt. Similarly, anticipated profits will be incorporated into the equity section, showing growth in retained earnings. This detailed forecasting helps businesses anticipate the impact of their strategic decisions on their overall financial health. These main budgets are often built from sub-budgets based on departments or business areas, such as sales or staff budgets. Transparency and accuracy are critical, as shown by McKinsey's survey indicating that advanced software for budget tracking significantly improves satisfaction among managers. Different budgeting methods. Choosing the right budgeting method depends on various factors, including business type and corporate culture. Here are some common methods. Account-based budget. This traditional approach organizes the budget according to the chart of accounts, which lists all the financial accounts used by the company. It's a straightforward method that aligns closely with the company's financial reporting system, making it easier to track income and expenses across different categories. Driver-based budget. This method focuses on key operational drivers that influence business performance, such as the number of products sold, occupancy rates, or production volumes. By linking the budget to these operational metrics, companies can create more accurate and dynamic financial plans that better reflect the realities of their operations. Rolling budget, also known as a rolling forecast. This method involves continuously updating the budget to extend its time frame, typically on a monthly or quarterly basis. This approach provides a flexible, forward-looking perspective, allowing companies to adjust their financial plans in response to changing market conditions and internal performance metrics. Top-down budget. In this method, senior management develops an overall budget for the entire organization based on strategic business goals. This overall budget is then distributed among various departments. This approach ensures that the company's strategic priorities are reflected in the departmental budgets, promoting alignment with broader organizational objectives. Bottom-up budget. This approach involves individual departments or units creating their own budgets, which are then compiled into a comprehensive budget for the entire organization. This method encourages greater involvement and ownership among departmental managers, who are often more familiar with the specific needs and challenges of their areas. Zero-based budgeting. Unlike traditional budgeting methods that start with the previous period's budget, zero-based budgeting requires each department to justify its budget from scratch for every new period. This method promotes cost efficiency by ensuring that all expenditures are necessary and aligned with current business needs, rather than being based on historical spending patterns. Budgeting and financial control. Budgeting is integral to financial control and strategic planning. It ensures that financial resources are effectively allocated to support business operations. A good budget system provides clear financial insights to stakeholders, promoting security, motivation, and transparency. Budgeting is essential for managing finances and planning for the future in any organization. It involves creating a financial plan that outlines expected revenues and costs. This plan helps allocate resources effectively to support various business operations. A well-designed budget system offers clear insights into financial health, providing stakeholders with the information they need to make informed decisions. This transparency helps ensure the organization remains secure and motivated, as everyone knows the financial goals and how they contribute to achieving them. Regularly checking actual performance against the budget, a process known as budget follow-up, is crucial. This allows businesses to see if they are meeting their financial targets and helps manage cash flow, ensuring there is enough money to cover expenses. Scenario planning, where different future scenarios are considered and planned for, combined with advanced software, makes this process more efficient. These tools help create a flexible and accurate framework for making sound financial decisions. Budgeting and financial control are vital for any business. They help allocate resources wisely, monitor financial performance, and plan for the future. With effective budgeting practices, organizations can achieve financial stability, motivate their teams, and ensure transparency, ultimately driving the business towards success. Budgeting is more than just numbers. It's a strategic tool that supports decision-making and financial control. By understanding and implementing effective budgeting practices, you can steer your business towards success, ensuring financial stability and growth. So, what are you waiting for? Start budgeting smarter today and pave the way to a prosperous future. Don't forget to like, subscribe, and hit the notification bell for more insightful videos on financial management.